Chris Galeski is the Director of Growth and Advice at Morton Wealth, guiding clients through comprehensive financial planning. Chris focuses on helping individuals navigate income allocation, investment decisions, and wealth protection to achieve their financial goals. Hello, Chris.
Hi, Phil. How are you doing?
Good, very good. Thank you. Thanks for coming on and joining us and explaining these really important topics. In this chat, I want to uncover the basics of financial advice. Who needs it? Why it exists, and how to create a financial plan with confidence. So I'm targeting this at someone who's just realised that they've got to get their financial plan together, their financial act together. What are the first steps in having a financial plan and allocating their income across the different needs and requirements that we all have?
Phil, that's a great question and a really important starting point. I think it's very hard to kind of decide which investments and create a financial plan without understanding the goals that you have with money. Not only things that you'd like to achieve, but some of the roadblocks that are getting in the way. I think of the role of the advisors to help find, save, and make you money, but all of those are tailored to what you're trying to accomplish. And look, I'm not in a position to put my values around your money. So the clearer you can be about these are the goals that I have and the milestones that I would like to achieve in life. And at a minimum, have a really good understanding of what income and expenses look like. We can help then make those tailored decisions for them. Because as we know, we can create a plan, but then life happens and we have to amend and adjust that plan tailored to our specific goals. So I think starting there is the most important step that people can take.
So what can viewers do though? Because, the cost of living is very, very high, and it can be very difficult to try and allocate something to investing and planning for the future as well. I mean, it really does take a serious decision sometimes to make that first step, doesn't it?
Yeah, there's no doubt that cost of living, especially here in Southern California, is extremely high. I often find people trying to take the steps to increase income by getting side jobs. And so they work a full-time job, then they have a side activity that they're hoping to make more income. But what I've found is that extra time and effort to make extra money, typically, if people took that and invested in themselves to become great at what they do, become real true experts and valuable within their organizations, their income is going to increase a lot more than that extra side hustle. But starting out early is very tough. And so, you really have to be focused on what income do I have coming in? What are my needs, my essential expenses that I need to spend money on? What are the things that I want to do? And create a framework that's built around that. And as much as possible early on, try to avoid that lifestyle creep, right? I made a little extra money, so I'm going to get a nicer car or a nicer place to live, because we really have to save and invest in ourselves first, whether that's for longer term goals like retirement, medium term goals like saving for my kids' education or a house, and really working together with your spouse or partner to help achieve those goals. If you're on your own, life again will change, and maybe eventually there is a spouse or partner that can help you achieve those financial goals. But really, it starts with a plan, what you're trying to do, and trying to invest in yourself as much as possible to become an expert to increase your income. That's where I think people could get a lot of benefit.
Then I think there needs to be a change in mindset though, don't you? It's like so many people in their 20s drift along. I mean, I know I did it, and they've got no plan. You're just having fun. You're enjoying life. And then maybe when you're in your 30s, that's when it clicks. What is the mindset change? And how can you allocate your income based on this mindset change?
I feel like you just described my life in my 20s. Phil, it's hard for me to pinpoint that, because I wouldn't be where I'm at today in the role that I have if I didn't spend my 20s doing what I was doing. And when I walked away from trying to play professional golf for a living, I was such a great golfer. I'm now a financial advisor. I mean, I had no money, but I had a lot of life experience. And so when I stepped into this, new job and new industry of becoming a financial advisor and hoping that people would, pay me to give them advice, if it wasn't for those life experiences, I wouldn't have had the success that I have today. And, everybody has to make a choice for themselves. do I want to spend my 20s gaining experience that could maybe help me later on down the road, or I'm taking a chance on starting something or a business? You have to understand if that doesn't work out, well, maybe you're going to have to work from 30 years old to 70 years old, unless you're, successful a lot faster. But if you are the type of person that gets your first job out of college or in your early 20s, as much as possible, looking at life and saying, what's a want versus a need? But as that income comes in, set some money aside to pay yourself first. There's all these sorts of stats and numbers that the average person here in America can't afford a $500 unexpected expense, like new tires. That's just not a good place to be in. And so when you're in that situation, if you don't have an emergency fund, then you go into debt and you're paying 25, 29% interest on that debt. That's where the cycle becomes really bad. You don't want to go in debt for fun experiences, and you want to be prepared for the life happen. So you've got to, as much as possible, set aside a few $1,000s for an emergency fund, then start socking money away for maybe a house or extra savings. And in some instances, I'm seeing this new generation, this Gen Z. They are very much on that mindset. They're going to the gym after work. They're going to coffee bars. They're not spending their 20s out at the bar at the beach, maybe like my generation, Generation X was. And so I'm seeing a little bit of a shift in certain generations, but it'd be hard for me to tell somebody not to chase their dreams or have fun in their 20s. It's pretty much the only time you have to do that without a lot of obligations.
And what's the kind of size of an emergency fund that someone should be considering? Because as you say, it's important. Most financial advice basically starts from that point. Before anything else, have an emergency fund.
I hate the answer, it depends, because I don't think that it does. I think at a minimum, people should have at least 4 to 6 months of their monthly living expenses set aside. So if, I have rent and need to put food on the table and pay for internet and cell phone in case I lost my job and need to find a new one, let's say that's $4,000 a month. I need somewhere between $16,000 and $25,000 in an emergency fund. And if you have that, when you start to invest and things go awry or there's volatility in your investments, you can be patient because you've built in time for those to come back. What I find is people take on risky investments because they want to get ahead in life, but they don't have the emergency fund. And the second that investment goes down in value, they get scared and sell it. And then all of a sudden it rebounds and goes up from there. So the emergency fund is one of the most important factors of setting yourself up for success financially.
Yeah, it's great that you bring up that point about starting to invest and having no clue about it and no understanding of, because most people start in the stock market, although many are going into crypto these days, of course, which hasn't been a bad plan for a lot of people, let's face it.
It has not. But, crypto is extremely volatile. And I know a lot of people that have invested in crypto for some time, or stocks for that matter, but they kind of go into it with the wrong mindset. They're very much speculators, not investors. They say to themselves, the world's expensive, life is hard, I don't really have anything now, so I'm fine risking everything because if this works out, I'm going to be better off. And that comes with the mindset with investing. Like, you have to look at yourself and say, am I speculating or am I investing? And there's a space for speculating. It's just you have to be careful with it.
And it is that procedure that you've got to go through where it's going to be a long-term compounding situation, because so many people think that that one investment is going to change their life, and it doesn't work that way, does it? And especially another financial advisor I spoke to said that so much of returns are based on the volatility that you can stomach, how much it's going to go up and down, because that's when you make the mistakes and that's when you lose the money, is when the volatility kicks you in the guts.
Well, I see it time and time again where you've got investment A and investment B. Investment A does well, investment B does poorly. People want to sell investment B and buy investment A. It's just not the way to invest. We want to buy low and sell high. And we also want to make sure we have things that work well in different environments. And speculation and that hope that this turns out and can change my life, financial advisors want to know that context too. Like, I think about it often when I've got client meetings. might send an email saying, hey, what are the specific topics that you want to talk about when we're here today? And they'll list out a few things. But what I really want to know is I want to know those thoughts that you have that you talk to yourself or your partner with while you're driving in the car over here. That's the important part. If you set aside X dollars to invest, what are you really hoping that it accomplishes? And then we can figure out the right strategy for you.
So, what's it like for you when you have a client meeting, when you're meeting people for the first time? Is there often suspicion?
Well, I think most relationships start out with the hope of trust. Like they're hoping because the lack of investment knowledge, they might not know the intricacies of which investments or PE ratios, stocks, bonds, alternative investments, crypto. And so they're just hoping that they come into the relationship with trust. And trust is built over time. We have to be on the same page with your goals, your ambitions, your dreams, the challenges that you face, the expectations for what certain investments are designed to do for you. And then hopefully enough education is built through those conversations around goals, around investments, around strategy, that all of a sudden you're in a relationship that's built on trust. So the initial conversations are really just kind of like almost like dating. We're getting to know each other. I want to learn about you. I want you to learn about us. And hopefully we're the right fit for one another to help each other strategize and find, save, and make more money on your behalf so you can achieve your goals. I had a conversation with a client the other day. Long story short, they were an executive at a major company. They had some stock options that were underwater for several years. They're getting ready to expire later this year. And the stock, fortunately, had gone up in value. They called me and they said, Chris, there's money there now. What do I do with it? So there ended up being about $30,000 of value there after taxes. And they said, should I just give it to you and invest? And I said, well, I don't know. Do you want to take another trip? Do you want another vacation? Because if you give it to me and invest, and let's say I do a really, really good job, and over the next 20 years, I turn that $30,000 into $150,000. Your kids get an extra $150,000. When you look back 20 years from now, do you wish you took that trip? Or do you wish that they had that extra $150,000? That's kind of the basis for our conversation.
Can you explain for viewers about 401k plans and retirement plans? How do they work?
So 401k plans are often a plan that's designed by your company. It gives you the ability to contribute to it, either pre-tax dollars. I get a tax benefit today by contributing to it, or Roth dollars. I have to pay taxes on the money that I earn today, but now I get to save it into this bucket that grows tax-free, and I can take money out tax-free in retirement. And alongside that, the employer will match or make a contribution. So maybe the employer says, we'll match 50% of your contributions up to this first 6% that you put in. If you're not putting in at least 6% into that structure, you're missing out on free money. And no one likes losing free money. So that's really the fundamental basic of a retirement plan. Companies have gone away from pensions where they're responsible for funding the contributions, managing the money and the distributions, and they've turned it over to the employee to save, invest, grow, and be responsible for their financial future. So it's not on the company's balance sheet anymore. I really enjoy 401k plans. I think people should contribute to them, but you shouldn't contribute to that and ignore other, structures or investment accounts that can help you achieve your goals. I mean, if I max out my 401k plan, I'm saving for retirement, but if I'm not saving enough in a different type of account, I may not have the money for a down payment on a house, an emergency fund, a car. We have to be conscious about those, along with where tax rates are today or in the future.
How are the funds invested in a 401k plan? Is it individual for each company? Does everyone have their own individual plan?
It is individual for each company, but there are some basics that sort of hold true. Most company retirement plans will have anywhere from 30 to 50 different investment choices, ranging from US stocks, international stocks, and some bond investment structures. So typically, they're all mutual funds or index funds. So you get broad diversification, broad exposure. But some of the choices are very generic. In most 401k plans, you don't have the ability to buy individual stocks or individual positions. Maybe you want to own gold. You typically don't have that choice. And the safer investments, like the bond investments, you typically have limited options inside of a 401k plan. So they're great to get started to help you, but as we've seen that stocks and bonds have become more correlated the last several years, it doesn't really help with that diversification. But they are good avenues to save and invest.
Okay, Chris, so we'll get on to allocation in the next episode. So thanks very much for the chat today, and we'll be talking in a few moments again.
Perfect. Thank you.